Hi everyone, welcome back. I want to share with you some ideas that we think about when we're investing. And today we're going to talk about inflation and how it can affect your money when you invest in stocks and real estate. So what is inflation? Well, inflation is just where the value of the dollar is going down. That means you have less buying power. Just give you an example. My grandfather once told me he was able to buy a loaf of bread with just a nickel. Today you have to pay $2.50. This can hurt your investment in stocks and real estate. The reason stocks go down in this environment is because stocks have to continue to make high earnings. It's hard to do that when the cost of your material is going up and your labor cost is going up and no one wants to pay your higher prices, so it's tough. Some stocks, of course, do well even in an inflationary environment, and these are like utilities and your consumer staples. The reason is because you're going to always pay for heating in the wintertime and air conditioning in the summertime. And you're definitely going to eat your food and you're going to buy toilet paper. So let's move on to real estate investing. So real estate can be good in an inflationary environment, especially those individuals who got that low interest rate, like 2.5%. Kudos to you. But for some of the younger people that's coming out today looking to buy a home, they're looking at those mortgage rates and their high interest and they're like, no. So the effect of inflation and interest rates definitely impact our lifestyle, and it also affects what happens in the stock market and in real estate. It also affects the developers because the cost of their labor and material is up as well, and they too struggle to raise their pricing. So at the end of the day, how do you protect your investment? Well, what you need to do is diversify. You're going to spread your money across different types of investment and keep an eye on what the government is doing with interest rates. Investing in things like real estate and commodities being silver, gold, even Bitcoin, can help you during an inflationary environment. So remember, stay smart with your money and keep learning about investing. Hello guys, today is February 16, 2024, and I just want to share with you something that I've been pondering. Let's look at the current U.S. inflation rate between 2000 and 2024. Now, I pulled this information off a site at usinflation/current-inflation-rates/. Now, if you look at this chart and you look at 2014, you see that the inflation rate was around 0.8. Then if you go to the year 2020, you see that the inflation rate was about 1.4%. Then in 2021, it was as high as 7%. Now currently, it's about 3.1%. It's higher than past years, but it's coming down. Now, I'm looking at an ETF called BITO, which is an ETF of Bitcoin strategy. You can pull this up on finviz.com. And if you look at the chart, you'll notice that this ETF is very bullish. And I've already explained what is a bullish stock in my past video, and I'll put a link down in the description below. As you can see, the price is above the 50-day moving average, above the 20-day moving average, and above the 200-day moving average. These are all bullish indicators, and everything's trending upward. Now if you look down below around $14 to $15, you'll notice this was a good low point for this ETF. I would consider that my desired buy area. Now if you pull up an option chain, put option chain, and if you go all the way down towards a desired price of $15, by the way, the expiration date for this option chain is January 17, 2025. So long story short, if you look at the bid price, it's $2.20. The ask price is $3. So that's a nice price that you could sell to a buyer for this put option. So, an idea to ponder. Each put option contract sold is equal to 100 shares. The seller of each put option with a desired buy price of $15 and an expiration date of January 17, 2025 receives a handsome fee of $2 per share, or in other words, $200 for each put option contract sold. The seller has to set aside $1,500 to cover for each put contract sold. The potential rate of return is equal to $200 divided by $1,500 is equal to 13%. Now remember, You have to do your own research before making any investment decisions. And also, I would recommend consult an investment advisor.
Hey, everyone. I need your support on YouTube.